What's up, guys? Welcome to another video. And today we're going to be covering inverse fair value gaps, one of the most important things that we use in our strategy.
So last video we discussed fair value gaps, which are imbalances in price, and price typically magnetizes or goes back to them and reacts with them in some way. If you haven't checked out our last video on fair value gaps, you're going to have a hard time understanding this one, so make sure you're watching the bootcamp videos in order. So if a fair value gap is to get interacted with, it'll either be respected, which we discussed in last video, or something will happen where it's inverse. So if you look at Jake's chart here, we have this fair value gap, and it's a bearish fair value gap because the first and third candle have a gap from the bottom to the top. And instead of price going into the fair value gap and just respecting it immediately and going back down, it instead comes up and a candle closes above it, meaning that the body of the candle is above and in the opposite direction of the fair value gap that was initially formed. So this is called an inverse fair value gap, and it's a clear indication that we are going to reverse in price and go in the opposite direction because we came in and balanced all those orders, and now we have strong momentum to continue going after balancing the orders, meaning that price is probably going to continue in that direction.
So, like Jack said, inverse fair value gaps are really powerful. And with this example right here that he showed you, this is a bearish fair value gap. So, like he showed you, the black candles are going down. This is bearish candle and bearish fair value gap. So when a bearish fair value gap gets inverse, price is going to move up. Bearish. Vice versa. So right here we see two white candles, two bullish candles. Fair value gap forms. We go in, we respect it, and then we inverse it in this candle right here. So when a bullish fair value gap gets inversed, we are bearish. Chop, 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 touch, respect, and then inverse. And then price continues to move down. And that is the fundamentals of an inverse fair value gap. They're really powerful. They're really powerful in showing you where price is going to move.
Also, a very important thing to note is just because price might go above it, that doesn't mean that it's an inverse until the candle closes. If you look at a candle, there's two parts of a candle. There's a body and a wick. The wick is the skinny part on the top and bottom, and the body is the thick colored in part. You want the body to close above the fair value gap or below if you're going in the short direction. So, for example, in the bullish fair value gap above, as you can see, one of the wicks went below the bullish fair value gap at multiple points actually, but those wouldn't be inverses.
Jack said, when the wicks go past the fair value gap, it does not count as an inversion. So, like you said, there's 4 points right here. These are not inverses. One, two, three. It only inverses when the body goes through it. So when the body closes through the fair value gap, that is an inverse. So right here, this is a bullish fair value gap. One, two, three, four. The wicks go down, they close below, not inverse until this point right here. Vice versa, we can see this wick right here closes above. That does not count. It counts on this candle right here. So if the wicks and the bodies aren't clear yet, just a quick explanation. So how a candle works is when price closes on one candle, it is the bottom or is the bottom or top part of the body. So the wick actually represents where price is moving during this. For example, this is a 15-minute candle. So during these 15 minutes, price goes up and down, and these are what the wicks are showing. When the body closes, the next candle, the body opens at that point. So the close would be at this low right here, and the candle opens, or the next 15-minute candle would open at this high right here. Price moves all the way down, it closes or it goes all the way down to here, it comes back up, it closes at this body right, the bottom of this body right here, and opens up at this next candle top right here.
And just so it's clear, inverse fair value gaps, just like regular fair value gaps, work on all time frames, and the higher time frames can show direction. So, for example, here on the 4 hour chart, we have a bullish fair value gap that gets inverse to the downside with that body closed below it, and then as you can see, price continues to trend down. So that would show us our direction and tell us that we need to go short in the future and get some trades going to the downside.
So that concludes the inverse fair value gap video. In the next video, we're going to be talking about how we conflate sweeps of liquidity and inverse fair value gaps.